Good evening, everyone. Thank you so much for joining us this evening for our seminar on tax savings during economic uncertainty. We're going to be talking a lot about different incorporation entities when it comes to real estate investing. And I'm really excited to have this discussion tonight because this is a topic that I speak to and get the questions on nearly every single consultation I have with real estate investors, especially our beginner and intermediate investors. Everyone wants to know, should I form an LLC? Should I form an S Corp? Can I buy real estate with my business? Should I move my real estate into my business? What are the pros? What are the cons? And this is going to be very, very informative to those of you who've joined us this evening. There is no one size fits all. Everyone, there different strokes for different folks, right? And so we're going to be discussing all of those points tonight. And if anyone has any questions, please feel free to enter them in the chat box, and we'll make sure to answer those at the end of the seminar. And I want to thank Tony. Tony, thank you so much for being here tonight. I know you're very busy, but our clients really appreciate your insights and your wisdom. So thank you so much. So without further ado, everyone, let's get this started. Okay, so a little bit about Marshall Reddick Real Estate. Marshall Reddick Real Estate is a real estate and investment organization. We help our clients buy and sell residential and long-term rental investment real estate. In any given year, we help our clients buy, sell, or 1031 approximately 800 properties. And we're also a property manager, which is the key that really allows this process to work so well. As we're helping our clients invest in other areas around the country, having a proper property manager on your side to make sure that your investments are running true and your returns are coming in as should be, really makes this work, right? And so right now we manage about 3,000 properties, and we're adding anywhere from 10 to 15 a month. We are also a private money lender. So we help a lot of real estate professionals with private money loans, from fix and flip loans to bridge loans to IO loans, things of that nature. We also help our clients invest in first lien holder position mortgages. And we also have an investment fund. And in the investment fund, our clients can pool their money together, and then we invest that pooled money into first lien holder position mortgages. So Marshall Reddick really gives the clients a number of fashions to invest in real estate, and all of these different assets behave differently. They return differently in different categories, at different speeds, at different volumes, at different rates. They all have pluses and minuses, and really what it comes down to is identifying what kind of strategy you're seeking in your real estate investment, and then we're going to help our clients decide which of these services is going to help them achieve those goals. So it's really, think of it as like a one-stop shop for real estate investing. A little bit about me. Nice to meet you, everyone. My name is Tyler. I've been a licensed realtor since 2017. I was born and raised in New York. I went to school for financial information and analysis and portfolio management. My play was to go to Wall Street. I found my way into real estate investing and never looked back. I did recently finish the negotiation mastery program at Harvard. And just a little bit about my business, I've done about 70 million in volume. I've closed real estate in 13 states. I have a personal goal to make that all 50 states. So if anyone in here is looking to do some business in Alaska, please let me know. That seems to be the toughest one so far. And I was recently featured on the Icons of Real Estate podcast. The reason I like to give this intro on myself is so that the clients understand when you're working with Marshall Reddick, you are working with educated and experienced professionals. Real estate is not a side job for us or a hobby or anything of that nature. Day in and day out, we spend our time helping our clients invest in real estate and accomplish their goals. And after this seminar tonight, I'll be following up with everyone on the call to answer any questions you may have. And I know I've spoken to a number of you before the call tonight. So again, That's my contact information right there, and I'll have it at the end as well. Please feel free to take a snapshot and reach out for anything whatsoever. On our website at marshallreddick.com/learn, we have an entire portfolio of educational content, from videos and articles to seminars. Every seminar we've ever had is recorded, tens of thousands of hours of video education, everything created by us. We don't copy and paste or anything of that nature. If you are looking to learn how to invest in real estate, there is a ton of really good, free, valuable information on this page. And so I would invite everyone here to take advantage of that. These are the markets that we operate in. The markets surrounded by the green box are where we have physical footprints and property management organizations. The other states we have agents in because we conduct a lot of business in those states, but we haven't opened property management there yet. So you can see we've got quite a diverse array of markets that we operate in. And again, they all behave differently. Some markets are going to be more of a cash flow market. Some markets are going to be more for appreciation. They'll have different tax rates. They'll have different speeds and volumes of return, so on and so forth. And again, my job as an advisor is to help understand your goals and what you're trying to accomplish, and then put together a game plan to make those a reality. Again, just another shot of our national footprint here. We have a number of offices in California and Texas. You'll find us also in Clarksville, Nashville, and Cape Coral, Florida. And so what to expect when working with somebody like me, right? So at any given point, anybody on here can request a free consultation, and you and I will sit down from anywhere from 45 minutes to an hour, and we're gonna go through this timeline here to help come up with your criteria and help come up with a game plan. So ultimately, you know, we wanna start with why. We wanna start with your goals. Some people might be entering retirement and need to offset that lost W-2 income. Some people might be trying to put together a nest egg for their kids' college educations. Whatever it may be, we need to understand ultimately what you're looking to accomplish. Then we're going to evaluate the options. Again, at Marshall Reddick, we have a number of options and they all behave differently. So we want to evaluate what's going to work and cause the effect that you're looking for. We're going to talk about your time frame, and time frame is important, right? Some people are going to be looking to accomplish a goal that's 15 years out. Some people need to create residual income today. So we're going to look at your time frame, and then we're going to set your criteria, right? What kind of investments are going to work for you? Then we're going to identify which of our markets have those investments available, right? Again, different markets behave differently, and so by understanding your goals, understanding the options, your time frames, and what your criteria are, we can identify which markets hold the assets that can make those dreams a reality. And then ultimately, the power of Marshall Reddick is our ability to introduce you to the people who can make that happen. You might be living in Southern California and you are entering retirement and you want to create an income source, right? We're going to go through all your options, and we may decide based on your capital and your time frame goals that, let's say, Seguin, Texas is a market that has assets that will work for you. We have Marshall Reddick employees and offices in those areas to help you know, locate and acquire these assets and ultimately property manage them for you. So that's the power of Marshall Reddick, is that you can own investment real estate, but still focus on your life, whether your life is your career or your children or whatever it may be. We have a one-stop shop here to allow your portfolio to expand with investment real estate without you having to be a complete hands-on landlord. And again, guys, thank you so much for being here tonight. We're really, really appreciative of Tony to be here and speak on the incorporating options for our clients. And here's my contact information, guys. I'm going to be following up with everybody after the seminar, but please feel free to reach out to me beforehand for anything whatsoever. And with that, Tony, I am going to mute myself, and thank you again so much for being here for the clients tonight. We really appreciate it.
Great, Tyler. Thank you so much for having me. It's always great to come back and speak with like-minded individuals on the real estate, on the business side of things. I am very much a pro real estate person myself. So let me just go ahead. Why can't I exit out of this? I have just a ton of client. Why is this? It's giving me a little bit of an issue on my end. Give me 1 second. Why is this not allowing me to exit out? Oh my goodness. Just keeps popping in and out. Let me see here. Sorry, folks. I don't know why this is giving me such a hassle here. There we go. All right. There's my presentation. Got it rocking and rolling. All right. Woohoo. Love it when technology works. Okay. So, once again, about 80, thank you again, Tyler, by the way. About 85% of my personal clientele are real estate investors. I'm sure that the 22, 23 plus people in today's webinar have either heard me speak before or who have heard about Robert Hull & Associates. Possibly we are, a pretty sizable accounting firm here on the West Coast. We do service tax filings in all 50 states, but mostly for real estate professionals, real estate investors, and small business owners, and once again, across all 50 states. So today's topic that I'm going to be speaking on is very near and dear to my heart, not only as a tax advisor, but also a small business owner myself. My wife is self-employed and she runs a little merchant branding business. Well, not little anymore. She's grown her business quite a bit since the pandemic. But the power of Inc., and other wealth retention tax tips. This is something that we apply on a day-to-day basis here at Robert Hull & Associates, obviously dealing with 85–90% of our clientele being real estate investors and small business owners. I myself am going on about 2 decades of service with Robert Hull & Associates. I am not only the public speaker for Robert Hull & Associates, but I am also a practitioner as an enrolled agent. I represent my clients in front of the IRS. Under any questioning or audit scenarios, as well as preparing roughly about 1,200 tax returns per year. Our firm does a whole lot more, and I'll get to our firm's information in a second here. My individual column range is in the $500 million range in real estate dealings, managed real estate dealings, and other small business dealings. So we do see a lot here at Robert Hull & Associates. And aside from tax preparation, I'm also the keynote speaker, and I usually average about 140 seminars, both in person and on the digital platforms on an annual basis. So we're all about education here, just like the Marshall Reddick team. They're all about educating their clients. We love helping and assisting our clients with the planning side of things, the education side of things, and obviously our #1 service, which is the tax preparation side of the tax industry. I by no means am a one-man operation. I work alongside a wonderful senior consulting staff. We're about 55 employees strong these days. The pandemic was a little bit of a rough go. We lost about half of our staff in 2021 to other industries, to, some people just wanted to leave California altogether. But we're back up and running to about 55 employees, and we continue to hire and continue to service larger files across the U.S., once again, in all 50 states. Bob Hall dreamed up about 50 plus years ago that he wanted his operation set up in one location and servicing a whole lot of services as far as, tax preparation, financial planning, estate planning, incorporating service. I mean, you name it, we offer it under one roof. We've been around since 1971, servicing, I think, roughly closer to about 11,000 tax returns nationwide, with only one location in beautiful, sunny Southern California, Glendale to be specific, right off the 134 at Brandon Central. Been in this building for, I think, 25 years, specifically in this building. And prior to that, Bob Hall actually ran his company out of a little home here in Glendale, California, coming from the education world, working in the Glendale Unified School District. He realized in 1971 he could, do a lot better on his own, helping clients and mostly helping teachers at the time with their tax filings, and then realized very quickly that he was good at what he did. And so he started to build his clientele list and became pretty much a powerhouse here in the Los Angeles County area. And now, once again, we're servicing about 11,000 tax returns nationwide. You can check us out online, roberthalltaxes.com, to learn more about our firm. But like I mentioned, we are a one-stop shop for pretty much all of your financial needs: tax preparation, incorporating services, internal auditing, financial planning, payroll services, you name it, we've got it. And obviously, we have wonderful vendor referrals, such as the Marshall Reddick, team down in Orange County. And I met Marshall Reddick, gosh, probably 16 years ago, 15, 16 years ago, the actual Marshall Reddick. And I've become pretty close and acquainted with the rest of the staff on their team. In fact, I believe that a couple of your associates have the same alma mater as myself. I went to Chapman University down in Old Town Orange. So, and once again, we're all like-minded people. So it's always great speaking for Marshall Reddick's webinars. Just a little bit of a senior consultant spotlight here: Candace Kane, Jackie Fu, Randy Redmond, some of our kind of shining star senior preparers. We do still have openings for 2023's filing season, which is, we're in the midst of it, February 27th. We've got the March 15th deadline coming up for the entity filings, and then obviously April 15th for the individual filings. So if you are in need of a consultation, or if you are ready to jump on board and need help with tax filings, we do still have appointments available for this season. If you have questions, or if you want to set up a consultation, go ahead and shoot me an email at TonyWatson@roberthalltaxes.com. I will end when we do Q&A. I'll end on this screen, so you don't have to take down my contact information right now. We can get that to you at the end. As a side note, I am not an attorney. I just want to make that very clear. This is only from a tax perspective. All the advice and the topics that we're going to be discussing today are solely perspectives and strategies from a tax professional, licensed tax professional. Sometimes I might seem like I'm stepping out of my lane of expertise a little bit, and I don't mean to do that. Even though I might know the answers when it comes to legal questions, I am not licensed to give you legal advice. So I just want to make sure that disclaimer is said first and foremost. So let's jump right into it. Is incorporating right for you? That's probably the billion or $1 trillion question for a lot of people, right? Or maybe just the $1,000 question if you're just starting off. Incorporating is not right for everyone. Okay, I want to make sure that is something that we start off with right out the gate. Incorporating makes sense if certain milestones are being hit. Certain revenue figures are being hit, depending on how much you own in personal assets, and if you need that asset separation benefit that incorporating offers. So in order to advise our clients to move forward with incorporating, we need to sit down with that client and map out answers to 3 very important questions. We've kind of dialed in the hundreds of questions down to 3 very important questions before we actually guide our clients in the right direction as far as incorporating is concerned. Question 1, what personal assets do you own? Do you own a primary residence? Do you have retirement accounts? Do you have inherited assets? Do you have brokerage accounts? What do you own that is attached to your Social Security and is a valuable asset, whether it be a current asset or a legacy asset? What do you own that's attached to your primary Social Security number? If you tell us that, well, I don't own a home yet, I don't have brokerage accounts, I don't have retirement accounts, I haven't inherited anything, incorporating is not going to give you the great asset protection benefit that most people are looking for, because you have nothing really to protect separately from your business at this point. But if you tell me that you have a home that has great equity in it, if you say that, my revenue is really starting to gain traction and I'm looking at, $100,000 in revenue last year, now it's $300,000, next year I'm looking at $500,000. Okay, so you're hitting those revenue milestones. You tell me that your parents are elderly and you're about to inherit certain assets that are going to be inherited by you personally, or maybe between you and some siblings. Okay, so you have personal assets that need protection separately from the business that we are trying to incorporate. So we check yes to box 1. Question 2 is about net revenue. What consistent net revenue figures have you been hitting? And when I say consistent, I mean 2 years or more running. What are those milestone net revenue figures that you've been hitting consistently over the past 2 years? I tend to look for a net profit amount of at least $35,000 to $40,000 in order for incorporating to make sense from a financial perspective. Meaning that I also need to make sure as a tax advisor that I'm not going to bury you in corporate filing fees, payroll processing fees, the franchise tax board filing fees each year, and that the corporate entity is going to save you more than it's costing you, right? And we've dialed it down to that $35,000 to $40,000 net revenue figure, to where that is actually where it starts to kind of break even for you. where an S corporation or a certain type of entity will save you just as much as all of the annual costs of filing will be that you will incur. So question 2, let's say that, hey, I've been hitting 35, 40 grand in net revenue. In fact, I've reached that and gone beyond 100 or $200,000. Okay, we check yes to question 2. Usually in question 1 and question 2, if I get those answered yes, I can guide the clients in the right direction or advise them to start the incorporated entity. But let's say that we answered no to question 1 and question 2. Question 3 is about risk and liability. In your specific industry, what levels of risk and liability do you operate at? I just incorporated a business in January for 2024 where they are starting up a lifeguarding instructing business, and they're going to be instructing young kids. They're going to be having the teenagers come, and then they're going to have the older generation individuals that are part of the training program. And the lifeguarding industry tends to run a little bit of a higher level of risk than other industries, right? Because you're having these kids jump into the ocean, swim out 100 yards and back to shore. You have them running up and down the sand, which is hard on their bodies. There's a lot of wear and tear personally on their bodies because of that. And so we incorporated that business right from the get-go simply because we wanted the asset protection moving forward. I also have 2 skydiving instructing businesses I do taxes for. Those tend to have very high risk in high risk in their respective industries. So, sometimes question 1 and question 2 might be no's, but question 3 might be a yes, and we might incorporate that person for the benefit and protection moving forward. So is incorporating right for you? I don't know. We got to sit down with you first and map out the answers to those questions, and then we can easily guide you in the right direction or advise you to start that entity. Now, let's say we check yes to all 3 questions. What are some of the options that we have as far as entity selection is concerned? The most commonly used entity is the one here on the left, known as the LLC. LLC stands for, I always like to mess around with this question when we're in a live in-person seminar. I usually ask people to raise their hands, and I ask, what does LLC stand for? And some people will say limited liability company. Some people will say limited liability corporation. And I say, okay, great. That's a good audience response. But I want to make sure that people understand that the LLC is not an incorporated entity. It does file articles with the state of California, but it doesn't file articles of incorporation. It files articles of organization. And therefore, an LLC does not issue shares of the business. It is owned by percentage. So if I am a single member LLC, I own 100% of the assets, the liabilities, the cash, whatever is held within that LLC, I own 100% of it. If I have a partner and we're 50-50, 50% of the liabilities, the assets, the cash, whatever's in the LLC, 50% is mine, 50% is my partner's. But we do not own the business based on any par value to shares issued, because there are no shares that are issued under an LLC. One other thing from a tax perspective, I want to make sure everybody understands, is the LLC will save you absolutely nothing in income tax. It won't save you a single dime of federal and state income tax, because it is not meant to be a structure that actually is a tax savings entity. The number one goal of having an LLC is to create greater liability protection. Now, once again, I'm stepping a little bit out of my lane of expertise, because we're dealing not with a tax implication here, we're dealing more with a legal benefit under the LLC. If you want to go into more detail about why the LLC might be better for you from a legal perspective, you'll absolutely have to talk with the attorneys that we have as vendors, or I'm sure the Marshall Reddick and the team down there, I'm sure they have great attorneys to refer you to as well. But the LLC, no tax savings. Unlike the C Corp and the S Corporation, which might actually help you save tax, depending on what type of revenue you're bringing in and what industry you operate in. Mainly and specifically the self-employed industries. So the realtors who sell property and earn commission income, the online Amazon sales businesses, the property management companies that manage portfolios for people. These are all self-employed industries, and therefore they have self-employed revenue streams. Self-employed income versus rental income, just as a side note, they're 2 completely different revenue streams from a tax perspective. Rental income only ever has to settle up with Uncle Sam for federal income tax and the state of California for state income tax. But rental income, one of the greatest things about cash flow is that it never has to contribute to Social Security and Medicare. Whereas self-employed income, like if you run an online sales business, if you're a realtor and you earn commission income, property management income, whatever your profit is through that business at the tail end of the year, you have to pay federal income tax, state income tax, and also 15.3% of Social Security and Medicare tax. That is also known as self-employment tax in the tax world. So the LLC, once again, great for holding and protecting large depreciable assets like rental properties, because the LLC at the end of the day is not going to save you any tax. So why throw self-employed businesses under solely the LLC structure if it's not going to save me anything? Whereas the C Corp and the S Corporation, depending on what type of business you're operating, those might be the go-to entities for self-employed revenue streams. The C Corporation in the tax industry is also referred to as a double taxed entity, meaning that if you have profit that's left in a C Corporation, not only do you pay 21% federal income tax under a C Corporation, you also pay 9.3% to the state of California. And then if you access some of that profit throughout the year, that's considered to be a dividend to you as the primary shareholder. So you pay dividend tax on the personal side. So C corporations are unique entities. They tend to be more for larger corporations like the eBays of the world, Starbucks, Amazon, Google, which have over 100 shareholders, and they're now required to file as a C corporation, and or if an individual has large medical expenses. That's one of the very unique scenarios where a C Corp would probably apply or give you provide a greater benefit over an LLC or an S Corp. C corporations allow for shareholders to deduct 100% of their medical costs. Now, that's not only for the primary shareholder, but let's say that you have an elderly parent that you're taking care of, and you're coming out of pocket $9, $10, $11,000+ for assisted care expenses because they're living in your house, but you got to have somebody come and take care of them throughout the day. That can be very expensive. I have a lot of clients who are doing that these days with their parents because their parents didn't have large sums of money to warrant kind of end of life care. And so they're having to dip into their savings and their own W-2s and their own businesses to pay for all of this. So let's say you're paying $100,000 a year in assisted care expenses. We would never set you up as an S Corp or an LLC because medical under an S Corp or an LLC is limited. In fact, the first 7.5% of your adjusted gross income, if you're an S Corp or an LLC, is not even tax deductible as far as medical costs are concerned. Whereas a C corporation, as long as you claim that individual as a dependent on your individual return, you get the full $100,000+ medical write-off because they are a dependent that is claimed on your personal return, and you are the shareholder that owns the C corporation. So you got to have these conversations with your tax advisor. Let us pull all of that information out of you and help you make the right decision as far as entity selection is concerned. I have a 2.5-year-old daughter at home, and I've been using this example more often nowadays because she's obsessed with unicorns. I mean, literally her whole entire room is like covered with unicorns. So I refer now to the S corporation as the unicorn entity in the tax world. It is truly kind of like the magical entity that helps you achieve both the great asset protection benefits that the corporate world has to offer, but all of the great income tax savings and sheltering benefits that we hear about on a day-to-day basis that corporate America gets to take advantage of day in and day out, right? Like how do you make $1 billion and pay yourself $1 in W-2 and have nothing in tax? Well, when you're at a Mark Zuckerberg level or an Elon Musk level, the game is much different. I've never even seen a tax return like that in my lifetime, but I have seen 25, 30, $35 million revenue stream businesses that are businesses that aren't incorporated, if you can believe that, because they've been set in their ways and they've used the same CPA or accountant for 20, 30 years, and that CPA might not understand the corporate world and how the tax returns are filed and whatnot. And so once you reach that $35,000 to $40,000 net revenue figure, you really need to find solace and comfort in filing as a subchapter S corporation. It is the only entity up here on the screen that you see here that can actually save you tax. And this is how it works. Under a subchapter S corporation, oh shoot, I thought that it was the different one. I'm gonna skip forward. I'm gonna come back to this because, oh, there we go. Yeah, for some reason that slide moved in front of the other one. Let's say that as a subchapter S corporation, you're earning $100,000 in net profit. This means after all of your expenses have been taken into account, you've got $100,000 in net revenue, and that is what you're essentially going to report as your profit to pay tax on to Uncle Sam. Under an S corporation, you get to take this $100,000 and split it into two numbers. One number is going to be your reasonable salary payout because now you're no longer self-employed, you are an employee of your own corporation. And employees, they don't receive 1099s, do they? They receive W-2s. So the federal government states that under an S corporation, depending on what industry you work in, like a medical professional, for instance, has to pay themselves a higher reasonable salary than a real estate professional does, because real estate professionals can go 3/4 of the year without making a single dime of income. And in the fourth quarter, they can close 500 grand in commissions, right? It's a very touch and go industry, whereas a medical professional has much more consistent revenue under their physician corporations, a contract physician entities. So let's say that you're a real estate professional, property management, commission earner, property flipper, rehabber, and you're flipping 3, 4+ properties a year, and you've got 100 grand in net profit. You are allowed to pay yourself a reasonable salary as low as 35 to 40% of your net revenue. So let's use 40% as an example. Let's say that you've got 100 grand profit, you pay yourself a $40,000 W-2, and now you get to fully deduct your income from the corporate profit. So you paid yourself $40,000 as a reasonable salary. You've got $60,000 left over in company profit. What you've just achieved here is not tax evasion, but you've achieved proper tax avoidance. Because now instead of paying federal, state, and self-employment tax on the full $100,000, you are now paying federal, state, and payroll taxes, not self-employment tax, but payroll taxes, which is Social Security, Medicare, on $40,000 of W-2 income. On the $60,000 that's left over now, sure, you still pay federal and state income tax, but you completely avoid, not evade, tax evasion is illegal, tax avoidance is not, you avoid 15.3% of Social Security and Medicare tax on $60,000 of company profit. That is just shy of about $10,000 in tax savings, and that's only on about 100 grand of overall income. So as you can imagine, let's cut that 100 grand in half, right? That 100 grand, if we drop it down to $50,000, you're still yielding an overall tax savings of about $4,590, and you're only making about $50,000 of profit through your S corporation. As you can see, the sole proprietor in the LLC column, you're paying the max federal tax rate, max state tax rate, and then the max self-employed tax rate. But if you look over to the S corporation column and paying yourself that 40% reasonable salary, nothing changes for federal and state income tax purposes, but you cut your self-employment tax by upwards of 65%, 60 to 65%. And so where I got that $35,000 to $40,000 net revenue figure I mentioned a couple slides ago, where that is kind of the milestone net revenue figure you need to be hitting in order for this all to make sense. At that point, at 35 to 40 grand, you're saving roughly around, let's say, $3,500 to $3,800 in tax. And that is almost equal or slightly over what the annual costs you'll incur are per year to file as an S corporation. You've got franchise tax board fee of $800, whether you made profit, lost money, or broke even. You got to pay California their parking ticket for parking your business in the state of California. It's $800 annual. You've got $25 to the Secretary of State to renew your company's information each year. So $825 total. You've got payroll that you have to run. And with a payroll company like Paychex or ADP, you're looking at probably an average of $800 unless you have other employees. If you're just a single shareholder corporation, it's just a W-2 for you, it tends to run about $800. So you're at $1,625. And then you've got your tax advisors and your tax preparers you got to pay. We charge $1,199 to $1,200 to file a return, a corporate return, whether it be an S Corp, C Corp, or multi-member LLC, which is partnership. So you're looking at what, $2,800 to $2,900 overall annually in filing fees. But if you're at $50,000 in net profit, you're saving $4,590 in overall Social Security, Medicare. You're still coming out positive in the end. In fact, the tax savings are not only covering all of the costs that you're incurring to file, but it's allowing you to retain a little bit of additional profit in your own bank account throughout the year. This is the unique calculation that your tax advisor needs to make for you before suggesting to incorporate, at least for any sort of tax benefit. We know that you're going to get great legal and liability protection out the gate. We're going to talk to the attorneys about the differences between sole proprietors and LLCs and entities and whatnot. But from a tax perspective, this absolutely makes sense if your net profit is consistently at $35,000 to $40,000 or more. At 35 grand, it's more of a break even where the savings are covering the costs. But at that point, you're still achieving great asset protection benefit. So have this conversation with your tax advisor before you go onto LegalZoom and start an entity. I just had a client, no joke, on Saturday morning, I talked to a client. He started 2 new entities last year, and we didn't talk throughout the year. He never called and scheduled an appointment, never did any consulting work with us. He just went to LegalZoom, started an entity, thought, okay, well, I'm going to start this business, so I need an LLC, because he watched a TikTok video or a YouTube video or something. And you got to be very careful. I love the fact that people are trying to educate themselves, but the TikTok videos are very generic educational videos. Some of them are accurate and they apply to some individuals that are watching it, but the thousands or hundreds of thousands or even millions of people watching those videos, it doesn't apply to everybody who's watching it, right? So this client went out, set up 2 new entities, and sure enough, when it comes time for tax time, I asked him, well, how's the business going? Oh, well, I haven't even set up a bank account yet, but I started it in June, and life got in the way, and I didn't manage to get anything up and running. And I'm like, well, unfortunately, we got to pay the state of California $800 per entity. You got to pay us to file the tax return, even though it's a zero tax return, it still requires a tax filing and all of this stuff. It ended up costing him like $3-4 grand just for those 2 entities to file, and he didn't generate any income. He didn't even acquire any assets, and it's all because he thought he was doing the right thing. And I'm not saying that he did the wrong thing. It's just he needed to have a conversation with us first so that we could tell him, hey, why don't we wait until January 1st of next year to file for the incorporated entity if you haven't really planted any roots in your industries yet, so that we don't have to pay all those costs for this year. Let's at least start January 1st and know what the costs are, and then maybe that'll give you a little kick in the pants to get things up and running more quickly in 2024. So just make sure that you have those conversations prior to filing all of that paperwork. Now that top 5 tax deduction slide that came before those slides, that meant to be the next slide here, but I wanted to mention a couple top tax deductions for you as investors, as self-employed individuals moving into our post-pandemic era. A lot changed over the last 5 years. If you can imagine that prior to the pandemic, not very many people were working from home. Sure, there were a lot of people that work from home, but not nearly as many pre-pandemic as there are post-pandemic. The LA Health Inspector's Office came and shut down the Robert Hall and Associates building for almost 2 years. Literally, they marched into our office. They said we had a complaint with one of the tenants in the building that said that, they said that you were seeing 120 to 140 people every single day, Monday through Saturday during tax season. And LA Health Inspector's Office in March or April of 2020, they said, not going to happen. And so we had to literally uproot our careers, the desk that I've sat at for my, over my 18, 19-year career. And I had to move everything home, and I had to set up an in-home office. I had to work with 2 children at home. They would come like those news stories that you hear about the kids, pushing down the door, coming in and asking me questions and crying and wanting food and everything while I'm in the middle of a consultation or on a webinar. That was the life during the pandemic that we were all kind of going through. Well, along with that scenario came a major shift and change in expenses for businesses. They dropped the brick and mortar leases, and they went home and they started to apply those costs to their in-home office. I had to buy a new laptop. I had to buy new monitors. I had to upgrade my internet speed. I had to upgrade my IT software. I had to buy an ergonomic chair, because I didn't know if 3 months later I'd be back in the office or 3 years later I'd be back in the office. So I literally set up the exact same setup that I had in my office at home, and that cost a lot of money. A lot of people weren't getting reimbursed by their companies for these expenses. So when we were all working from home, we incurred these costs that just have become part of our daily, operations costs, is what I'm trying to say. One thing that I saw change the most, though, during the pandemic, aside from the equipment and the furniture purchases and whatnot, the number one change during the pandemic was marketing and advertising. I can't stress this enough. I saw an immediate and direct correlation between businesses that had increased revenue during the pandemic and equally as much increased marketing and advertising costs. The more people were marketing and advertising, the more the revenue was. 2020, 2021, 2022, they were applying for PPP, EIDL loans, all of that kind of free money during the pandemic, and they were plugging all of that money into marketing and advertising. And I had people literally over the past 3 years, which is crazy to think about, over the past 3 to 4 years, turn their $100,000 revenue businesses into $1 million operations. In fact, Tyler, I was just sharing with Tyler a conversation about these little skateboards that you see here hanging on my wall. A client who was a waiter, a bartender during the pandemic, the restaurant shut down, so he bought this special machine that makes epoxy molds. And now I think he's at $3.5 to $4 million in net profit over a 2 or 3 year period. He makes skateboards and surfboards and wall art for celebrities, famous rappers, movie stars. And he completely shifted his way of thinking, all because he saw the writing on the wall. He's like, I don't know when I'm going to be back bartending or waitering at this restaurant. The pandemic doesn't seem to be slowing down anytime soon. So what he did is he went to Instagram and he plugged in, not only did he buy this massive piece of equipment and has a warehouse now and staff and all of that stuff, but he turned to Instagram and to TikTok and all these other business platforms, and he spent hundreds of thousands of dollars in 2020 marketing and advertising his business, and it paid off big time. That's one unique example. Then I have my realtor clients who did a lot of marketing advertising, and when most realtors weren't able to do the door knocking and the handshaking and the face-to-face operations, the people who were able to pivot to the digital way of doing business and while still marketing and getting their names out to larger target markets, they actually sometimes even double and tripled their revenue from pre-pandemic numbers. Unlike some other individuals who stopped marketing and advertising and their income either plateaued or completely fell off a cliff. Marketing and advertising, dollar for dollar tax deductible for the self-employed world as well as the real estate professional world. Number two, professional supplies and equipment, the computers, the fax machines, the cell phones, the laptops, monitors, desks, chairs, filing cabinets, shelving units, storage units, great dollar for dollar federal write-offs. And one thing that I want you to know is that these expenses that you see here, this picture that you see here, these items have one of the lowest audit risks out of anything under the Internal Revenue Code. In fact, in 19 years that I've been doing taxes, I've yet to see an audit on an iPhone purchase. I've yet to see an audit on a MacBook purchase. I've yet to see an audit on a desk or a chair purchase. And that's because the IRS knows that in today's day and age, these are the most common expenses that business owners will have for their business. Let's face it, how many people do you know who can do what they do professionally without a cell phone, without a computer? I mean, look at how we're connecting today. So make sure that you're maximizing these particular deductions as much as possible, especially for this last year and moving forward, if you haven't already prepared 2023's tax return. Now, about 4 weeks ago, the federal government received a bill or an addendum to the current Internal Revenue Code from the IRS. They want to bring back something called bonus depreciation. And I want to make sure that people understand the ins and outs of how to really maximize this deduction. If you are self-employed and you are looking to acquire a new vehicle, I'm sure that you all have seen in your day-to-day business or traveling day-to-day operations, the amount of 6,000-pound or heavyweight vehicles driving around your neighborhoods and in the city areas, like the Tesla Model X's, the G-Wagons, the Chevy Tahoes, the Rivian trucks. I mean, you know, these massive cars, whether they're electric or gas powered. I think, and I'm not going to say that there's a ton of those on the road specifically because of the tax code, but I know that this absolutely fueled the market for these heavyweight vehicles. The federal government back in 2018 introduced or actually brought back a part of the Internal Revenue Code that allowed 6,000-pound or heavier vehicles to be dollar for dollar tax deductible for businesses as long as they were titled, insured, and paid for under a business name. Now, at that point, once again, titling, insuring, and paying for it under a business name, that legitimizes it as a true business write-off. Your insurance might adjust a little bit. You might have to pay a little bit more car insurance if you do title the vehicle under your business name. But at that point, it becomes a corporate asset, and therefore your car insurance is also tax deductible, even though it's at a little bit higher of a rate. Normally, after the tax savings, it nets out to be the same amount as you were paying prior to just owning the car personally. Now, some of you might be thinking, well, what the heck does 6,000 pounds have to do with anything? Well, if you think about it, the more most of the 6,000-pound or heavier vehicles, which include Ford, GM, Chrysler, are all produced and made here in the U.S. If you think about it, the foreign assets, sure, you've got the Cayennes and the Toyota trucks and, you know, the bigger SUVs like the G-Wagons that are made abroad. But a majority of those larger vehicles are GM and Ford, right? Made and produced here in the US. So this particular benefit that allows you to dollar for dollar deduct a heavy vehicle wasn't really meant for us, the consumer. It was really meant for the FedEx companies of the world, the UPSs, the Amazons of the world. If you've seen those new Amazon Sprinter vans, some of them are even like natural gas and electric vans now, these big, beautiful Sprinter vans. The reason that they're brand new is because Amazon and FedEx and you know, UPS, they all wanted to take advantage of this particular part of the code, and they were able to dollar for dollar deduct 100% of the cost of these vehicles on their federal tax returns. Well, the code never distinguished that it was just for those companies. So therefore, I have realtors who are going out and buying brand new G-Wagons and Range Rovers and dollar for dollar deducting $120,000 to $130,000 vehicles to completely offset their federal taxable income. Now, California doesn't conform to this. Okay, let's say I've got 120 grand in profit. I go out under my corporation, I buy that brand new Range Rover, and it's titled, insured, paid for under my corporation. The 120 grand of income is then wiped out by the 120 grand expense on the federal side. But California doesn't conform to that. So California is going to add back a greater portion of that depreciation. So I'll still owe the state of California on the profit. So you got to talk to your tax advisor about this. And 4 weeks ago, take a trip back in time, in 2021, under the Inflation Reduction Act, under Biden's administration, they were set to phase out this benefit by 2027. In fact, it was supposed to be 80% benefit last year, 60% this year, 40% in 2025, 20% in 2026, and then fully phased out in 2027. 4 weeks ago, Congress received this new bill, and there's about a 95, I'd say probably close to 98, 99% chance that they're going to bring back this 100% bonus depreciation, which is fantastic. So you're going to see a lot more people out there upgrading their vehicles, titling, insuring it under their businesses, and driving these large, beautiful assets. Here in Los Angeles, we see it all over the place. I'm sure that in Orange County, you see it as well. And there's a reason behind that, especially if that person is self-employed and operates a business. So keep that in mind. If you're not looking to upgrade a vehicle, you're probably going to deduct the mileage write-off, which is at about 60 cents per business mile. You cannot take both, by the way. You can't take the bonus depreciation and mileage. It's one or the other. And usually, nine out of 10 times, the depreciation is going to give you a much larger write-off than the mileage deduction, right? Now, if the car weighs under 6,000 pounds, don't worry, you still get a bonus depreciation write-off for it, but maxed out at about $20,500. So just keep that in mind, that the 6,000 pound gross weight, not curb weight, this is really important, by the way, when you go on Google and you search weight of a vehicle, you got to type in gross weight and not curb weight. Curb weight is always going to be about 1,000 to 1,200 pounds less than gross weight. This is 6,000 pounds or heavier gross weight vehicle. And that's what's going to give you that large upfront 100% bonus depreciation write-off. Number 4, legal and professional fees. Back in 2018, W-2 wage earners lost all unreimbursed employee expenses as write-offs, but the self-employed world didn't change. And so therefore, I want to make sure that everybody who's self-employed, who has passive or non-passive income from real estate investments, commission income, online sales income, whatever that self-employed kind of passive or non-passive income stream is, you are still allowed a legal and professional fee deduction for your tax advisor costs, for your attorney costs, basically anything in the legal and professional consulting world that you pay for on an annual basis. Still a great write-off for you and is dollar for dollar. Property deductions, just wanted to touch on this briefly. In-home office deductions, you should not be afraid to take a deduction for your in-home office. I know that there are a lot of preparers out there in the industry who are deathly afraid of taking this as a deduction, and I want to squash some of the misconceptions here about the in-home office deduction real quick. It's not the form that gets people audited, it's the unreasonable allocation of square footage that gets people audited. Meaning that if I sat here on today's webinar, I said everyone should take 25% of their in-home office as a write-off, or 25% of their home as a write-off for in-home office. Well, I might live in a 1,000 square foot home. You might live in a 5,000 square foot home. There's a big difference between 250 square feet of office space and 1,250 square feet of office space, right? You're looking at a much larger office space, and the federal government is probably going to want to question a 1,250 square foot office space in a 5,000 plus square foot home, right? It just doesn't seem reasonable. Now, I do have clients. I live here in Los Angeles. I've got sound recording clients. I've got movie production clients. I have people who have literally converted their 3-car garages into sound recording studios, movie editing theaters. Plus, that doesn't negate the fact that they have their in-home office as well. Plus, they get to include the nearest restroom as part of that square footage. So if it is true that you have that much space inside of your house as an office, just understand that it could throw up some red flags. But if it is true, take it as a deduction. At the end of the day, if you have a licensed preparer allowing this to be a deduction on your return and advising you how to take it, we're the ones that go to bat for you under audit. It's not like we just throw the paperwork back to you and say, hey, have at it with the IRS. IRS would walk all over you. We have you sign over tax power of attorney to our advisors. We go to the IRS. We argue our stances on certain deductions that are ordinary, necessary, and legitimate. And truly, if you have your garage as a recording studio, you've got your in-home office, which is a 12 by 12 room plus the nearest restroom. I mean, shoot, yeah, 25 to 30% of your house could very much be a legitimate in-home office deduction. My point is, do not be afraid to take this as a deduction. That is the worst approach. This is very much an ordinary, necessary, and legitimate write-off. If you are self-employed, please, please, please do not work with a tax advisor who says we shouldn't take it out of fear of your return being audited. That is the wrong approach, okay? I think I've hammered that enough. Some changes on the horizon for incorporated entities. If you incorporated prior to January 1st of 2024, so if you incorporated in 2023 or in a past year, this doesn't really apply to you until January of 2025. But if you recently met with your legal advisors or your tax professionals and you filed an incorporated document to incorporate yourself as an LLC, S Corp, or C Corp in 2024, there is new compliance ruling on something called a BOI report, Beneficial Ownership Information Report, which is essentially, it's a very simple filing. It takes about 5 or 10 minutes online to file. This is to tell the government, hey, I, Tony Watson, am sole owner of TW Real Estate Incorporated. And it's just to disclose who the owners of these U.S. entities are, whether it be, once again, an LLC, S Corp, or a C Corporation. The main goal behind this, and I actually do feel like this is something that the government was lacking transparency of over the past probably decade to 20 years, I'd say. You know, the CTA, I just want to read this really quick. The CTA is primarily an anti-money laundering law aimed at preventing bad actors from concealing ownership to facilitate illegal activities like money laundering, terrorism financing, if you can believe that, and tax fraud. I know all about the tax fraud. I know nothing about terrorism financing, so I'm not even going to pretend to know anything about that. But I do know that there's a lot of money laundering schemes that are out there as well. I mean, fraud and identity theft are the #1 and #2 crimes globally across the world, right? Across the global economy. The federal government wants to know what foreign individuals are out there that are ownership or have beneficial ownership in United States corporations. They're tired of shell companies in the Caymans and the British Virgin Islands and, you know, these foreign entities coming in and owning majority stakes of US corporations and not disclosing this to the federal government. I'm actually not opposed to this part of the bill. I know that I'm opposed to most government overreach, but I actually really enjoy the fact that they're focusing on this nowadays, because enough is enough, people. I mean, you know, this is not so much like preventing us from sheltering our income or giving the government information they already don't know about, right? Because the government knows where my information is. My social security number, my wife's social security number, my kids' social security numbers, our bank accounts, all of that information is not public knowledge, but it's information that the government really already has. This is not meant to focus on us, the United States taxpayer. This is meant to focus on the foreign investors that are majority stake owners in US corporations, really to prevent, once again, money laundering, tax fraud, identity theft, and terrorism financing. If you incorporated in 2024, you have, normally it's going to be, or moving forward, it's going to be 30 days from the original date of incorporation to file this. So LegalZoom and other incorporating businesses will probably end up filing this for you. But because it's so brand new, the government is giving you 90 days to file this if you incorporated in 2024. Once again, if you incorporated prior to the end of last year in 2023 or in previous years, you have until January of 2025 to file your first BOI report. So keep all of that in mind. This does apply to LLCs, S Corps, and C corporations, not just one particular type of entity. Last but not least, and then we'll get on to Q&A because I know I'm getting to the top of the hour here. One of the holy grail elections, much like I stated, the S corporation was the holy grail entity. One election that I've seen filed more in the past 3 to 5 years than probably collectively over my almost 20-year career is something called a cost segregation election. This is a real life organic example because this is a client that came to me in 2021 to file for 2020's tax year. LADWP city worker, W-2 at 120 grand. This client owns 3 rental properties. This client made some great investments, paid down the debt, had made some good moves in the stock market, and eventually bought, you know, this 3-property portfolio. As you can see, about 1, 2, 3, 4, 5, 6, about 6 lines down from the top, you can see rent, royalty, partnership, S Corp, trust income. That 33 grand right there is solely cash flow on his 3-property investment portfolio. And he comes to us in 2020, comes to me in 2021 and says, hey, listen, Tony, I know we've prepared this document for 2020. I don't really want to pay tax on my rental income. Is there anything that I could do? I've already improved the property. I don't need to redo kitchens and bathrooms or solar or anything like that. Is there anything else that I can do to help further reduce the tax exposure on the 33 grand of profit? Because right now in this scenario, he was owing about $4,000 to the IRS and to the state of California about $4,200, so about $8,300 total in liability. And I'm thinking, well, you actually seem like a pretty good candidate for cost segregation. And he kind of looked like a deer in headlights. And he's like, well, what's cost seg? And I said, well, let's send your property addresses over to our cost seg specialist and see what, if anything, that cost seg election can accelerate in future year depreciation so we can take the deduction now, rather than waiting 27.5 years, which is the depreciation lifespan of a residential rental property. Instead of waiting all that time to get the write-off, let's see what we can accelerate to take in this year, save the money now so we can buy more real estate. And he goes, sure, that sounds great. We send the property portfolio addresses over to our cost seg specialist, and the cost seg election comes back and it says in the preliminary figures that we can accelerate $400,000 of future year bonus depreciation. Now, for some of you who are veteran investors in the room, you know that depreciation is great while you own the properties, terrible if you ever sell the property. So we'll get to that in a second. But through this cost seg analysis, we're able to accelerate $400,000 in bonus depreciation. It's also referred to as a 481A adjustment, and both the IRS and the state of California conform to Section 481 of the IRC. So this individual, like I mentioned, is not a real estate professional. He is a city employee. He is making just shy on the federal side of, or just over 155 grand. So I know automatically as a non-real estate professional, he's going to be limited to what loss deductions he can take on the real estate side because he's not a real estate professional. So when we get this 400 grand number back, we're able to accelerate and take $40,000 as a deduction, or 40,000 and change, against his 33 grand in net profit. It looks like about 44 grand and change that we're able to take. And so he's got $356,000 in unallowed depreciation out of that 400 grand. We take the 44 grand, as you can see, his 33 grand in profit drops to an $11,000 loss. Now he's looking at a $5,959 federal refund and a state refund of about $1,392, about a 15 grand delta, right? Which he is now going to capture that 15 grand tax savings, pocket that, and then the $356,000 that's left over, he doesn't lose it, he just doesn't use it, right? So because he's not a real estate professional, he is only allowed 44 grand and change of it, and the remaining portion of the 400 grand carries forward into 2021. If he doesn't use it all in that year, carries forward into 2022. And hypothetically speaking, let's say that every year he's at a 33 grand cash flow. That means that this cost seg election in 2020, for the next 9.7 or 9.8 years, this client will pay zero federal and state income tax on 33 grand of property cash flow. Well, this client was so ecstatic. He's like, wow, I'm saving 15 grand this year. This year I can, and then that's for 2020 and 2021. He realizes, well, my cash flow is going to be probably more this year. That's going to save me another 15 grand. He then saves 30 grand over a 2-year period. He ends up buying another property in 2021 because he didn't have to pay all this money in tax. And guess what we did in 2021? We did another cost segregation election. So I believe moving forward into 2024 this year, we haven't met for 2023 preparation yet, but in 2024, I believe he's going to have roughly about $700,000 in what are called unallowed passive loss carry forwards, meaning that literally he could cash flow 33 grand a year with $700,000, let's say, of carry forward losses. That means that for the next 21.2 years, right, he can make 33 grand in profit and pay nothing in federal and state income tax because he has this kind of credit carry forward offsetting future revenue. This is the power behind cost segregation, and one of the greatest things about the bill that is in play as of 4 weeks ago is that we're no longer going to be limited to 80% or 60% on the bonus depreciation, because it was supposed to phase out by 2027. This particular bill that's on Congress's desk right now that might cause a looming shutdown of the government, hopefully not, but when that bill passes, they are going to bring back the 100% bonus depreciation benefit for accelerated bonus depreciation. So keep your ears and eyes open as soon as we know whether or not that's going to pass. And I'm a betting man. I love going to Vegas, playing some blackjack and some slot machines. Wheel of Fortune is my game. I love doing all that. I am a betting man, so I bet that this will pass and 100% bonus depreciation will come back. If they don't pass that, just understand that the cost seg industry is $1 billion industry. If they don't bring that back, $1 billion industry goes bye-bye over the next 2 years, okay? It just evaporates into thin air because there's really no point in doing cost segregation without bonus depreciation, just as a side note, okay? Last but not least, before we do Q&A, I did want to mention once again, 2018, there's something called a QBI deduction, where if you are married filing joint, you're going to go to the blue column. If you're single head of household, you're going to go to the red side. Your goal prior to the end of the year is to sit down with your tax advisor, map out a plan to keep your taxable income below one of these two thresholds. Married filing joint is going to be what? $364,200 or below. Married filing joint is going to be $364,200 or below. Single head household below $182,100. And that means that if your taxable income is below that threshold, the first 20% of your self-employed profit and or cash flow from your real estate, the first 20% pays zero federal income tax. Example, my wife and I both, let's say, real estate professionals. I bring in 150 grand. She brings in 150 grand. Total together, let's say our taxable income is $300,000. We're below 364,200. So we qualify for QBI, which makes 20% of $300,000 tax-free on the federal side. That's $60,000 of tax-free income, and that's been around since 2018. At a 25% tax rate, that's about what, $15,000 in tax savings, just by planning ahead prior to the end of the year to ensure that we're below one of these two thresholds. This should highlight the power of year-end planning. Tax season is busy for us, but even more so, what a busy time of year is for us, at least here at Robert Hall & Associates, is fourth quarter planning. We have like mini tax seasons in October, November, and December, where we try to cram in all of our kind of winding down consultations for the annual wind down sessions to where we can ensure our clients are set up in the right positions. And that way there's no surprises come tax filing time. We already know what the tax return is going to look like by planning ahead. What's that famous saying? Failing to plan is ultimately planning to fail. So plan ahead so that you plan and for success in the following year. And if you don't put a plan in place, you're probably not going to enjoy any good results, right? You're not going to like the results. So let's make sure that we set aside some time towards the end of the year to talk with your tax advisors. All right, so hopefully there's a lot of Q&A. I don't know if there is. I know that I sometimes speak a little quickly, and if you have more personal questions and you'd rather just set up the consultation, shoot an email over to TonyWatson@RobertHallTaxes.com. We'll get you all scheduled for a phone call or a Zoom call, or even in person. If you want to take the drive up to Glendale, California, we'll meet in person. We are very much back open and running for business. So I'm sitting here in my office in Glendale, readily available to meet with clients. So Q&A, Tyler, if there's Q&A kind of locked in here.
There absolutely is. And Tony, thank you so much for all of that, guys. I know that was a lot of valuable information. I want to remind everyone that a recorded copy of this seminar is going to be emailed out to everybody after this, right? So you'll be able to go back and reference, but certainly reach out to Tony with your questions, because there was a lot of good information in there, Tony. I learned a couple things, and I actually have some questions as well, but we did have a couple questions in the chat box, so let me dive in here. So Justin asks, if my S corporation operates in multiple states with varying tax laws and regulations, how do I accurately calculate and allocate income deductions and other factors for each state, considering potential differences in sourcing rules, nexus thresholds, and state-specific tax treatments?
Yeah, I mean, it gets pretty complicated if you have one entity that operates in multiple states. You have to, and this is where a good bookkeeper comes into play, because a bookkeeper can organize your expenses per month by class. And also allocate the expenses per job that is done within other states. If you have one S corporation and you operate in other states, we have to look at what the standard deductions are in those states. And as long as the K1 profit from your S corporation allocated to that state is below the standard deduction, you do not have a filing requirement in that state. However, if you are flipping properties, normally, even if the profit is below the standard deduction, because you have the high gross sale price that needs to be reported, you'll still have to allocate that specific sale of the property in Texas. Well, Texas has no state income tax. That's a bad example. Missouri or Alabama or Wyoming, you'll need to allocate that K1 to that state. You don't have to be incorporated in that state, but your S corporation in our tax software, we can allocate to whatever state actually has a filing requirement. And as that K1 passes through to your individual tax return, we actually add those individual states in onto the individual tax return and file accordingly. Now remember that California has double taxation treaties, I call them, with most states, meaning that you won't pay tax in 2 different places. So if you're paying tax, because California taxes you on your worldwide income, if you're paying tax to the state of California on revenue that was generated in Wyoming or Wisconsin, you get a California credit against that state liability. And normally Wyoming or Georgia will require you to attach a copy of your California return. I just did one yesterday where I had to attach a California copy of the return, a PDF attachment to the e-file to show, what state was it? It was Ohio, I think it was. Ohio required me to attach a California copy of the return just to verify that the state over state credit would apply. And the client didn't owe anything to Ohio because he had already paid or was generating a high enough liability in California to offset any liability in the other state. Gets pretty complicated, not gonna lie. That's a pretty complicated filing, and you'll have to file in a couple different states, barring what each state's standard deduction is and whether or not there is a filing requirement.
Thank you, Tony. Dan asks, is cost seg for everyone? If not, who's a good candidate for cost seg?
Cost seg is really a conversation that everyone should have, but it's not going to apply to everybody. It works best with properties that are newly acquired, not new build. I mean, it works fantastic with newly built properties because everything is brand new, and we could take probably 80% of that build and fully accelerate the depreciation on the building. But I'd say that after 2 years of ownership, the benefits of cost seg start to dwindle down. I'm not saying that a 5-year-old property can't be cost seg, but normally if it's 5 years or older, there needs to be substantial improvements, capital improvements to the property in that 5-year period in order for cost seg to make sense. Cost segregation is only on rental properties, okay? It's not on primary residencies or in-home offices. Cost seg is specifically either on residential or commercial rental investments, and it works best with either newly acquired properties that you just purchased. Let's say you just purchased it in 2023, then you do cost seg for 2023. But if you purchased it 7 years ago, no, you would not do cost segregation on that 7-year-old property unless last year you gutted it down to the studs and put $500,000 into a new build. At that point, yeah, we could do cost seg on it because you've got a lot of that great depreciation built up in that new build that we can start to accelerate at the cost seg level. It's not right for everyone, and I can't really specifically state who it would be right for without seeing some of these numbers, without seeing people's individual scenarios. It's very hard to be, in my industry, it's very hard to be general with advice. You know, the general advice that I give everybody is everybody should do tax planning. That's probably the most general advice I could give people. But as far as telling each one of you what you should specifically do, we as advisors here at Robert Hall, we would need to sit down and look at your specific scenario because not everything is going to apply to all 22 people in today's webinar, unfortunately.
Thank you, Tony. Well said. And this is our last question, and this is a Tyler question. Tony, you had mentioned earlier, you know, when we're looking at, you know, audited purchases, and you had mentioned that things like office supplies, phones, computers, these are the least audited purchases that you see in your profession. My question for you is, what are the most commonly audited purchases that you see when the IRS comes looking?
So, I mean, yeah, it's no surprise that the in-home office deduction form is one of the highest scrutinized forms on an individual return. Meals used to be a highly audited section, but during the pandemic, because restaurants were hurting so badly and entertainment facilities, including movie theaters, they were being hurt so badly because people just weren't allowed to go to the movies or go and sit at restaurants unless there was outdoor dining and they had to wear masks and, you know, like hazmat suits if they wanted to sit, you know, outside and breathe fresh air, which was insane. But at the end of the day, the main deductions of entertainment still tends to be a higher risk of audit in home office. Entertainment is only a state tax write-off now. The federal government does not allow entertainment as a deduction. Now we can be a little bit creative depending on the entertainment cost itself. Some are more like team event expenses, or you know, you buy a set of tickets to a Dodger game or a hockey game or a Laker game or an Angels game, wherever you're going, and you want to raffle it off, those are raffle prize deductions. Those aren't entertainment expenses. So there's some ways to kind of navigate around that part of the code. Travel tended to be a much higher audit risk in previous years pre-pandemic, but the federal government wants people to travel. They were locked inside of their homes for almost 3.5 years. Now people are out there traveling again, even though doors of planes are flying off and whatnot. But they want them out traveling again. These are great dollar for dollar deductions. Probably the highest audited deduction is, it's, to be real honest with you, case study wise, it's probably going to be the same deductions as pre-pandemic, but the one audit that I've seen, and I haven't seen very many audits, at least in my column or of the Robert Hall columns over the past 5 years, because we prepare we prepare a hell of a return. I'll be fully transparent on that. I saw the IRS audit not a corporation, but the corporation was paying the shareholder rent per month to rent out space inside of the shareholder's home. And the individual shareholder wasn't paying enough rent per month to cover all the costs of the in-home office. So on the individual return, the in-home office deduction was running at a loss. And there's something that happened during the pandemic where the federal government put a highlight or a main focal point on basis allocation in investments, meaning that because it is the shareholder's primary residence and they own the corporation, essentially they don't want this shareholder paying rent and then taking a loss on a rental property that isn't a rental property, right? So at the end of the day, the federal government made a slight adjustment in that audit. The client ended up owing, about $800 back to the federal government. It wasn't a huge change at all, but I realized that the federal government doesn't want to see losses on that. So we tend to look at the average monthly costs on the in-home office side and adjust the rental expense out of the corporation to be equal to whatever the expenses are. So instead of showing a loss, we're just showing a break even. But to answer your question, it's going to be kind of similar to pre-pandemic. Meals are always kind of going to be a high target audit item. Your travel and your in-home office, those are probably the top 3 still. But still with, once again, incredibly low audit risks. S corporations, by the way, have less than a 0.35% chance of being audited. Not 35%, not 3.5%, 0.35%, okay? Once again, I'm a gambling man. I'll take those odds any day of the week, right? Whereas an individual sole proprietorship, somebody who isn't incorporated but has self-employed income, that Schedule C has a 1 in 75 chance of at least receiving some sort of correspondence from the government, maybe not an audit itself, but some sort of correspondence from the federal government or the state of California. So the audit risk on the sole proprietorship side tends to be a little bit higher than the incorporated entity. And I think that everybody needs to understand that when you're deducting expenses on your return, just make sure that your preparer is explaining to you what is ordinary, necessary, and legitimate as far as business expenses are concerned. Anything that pops off the page or off the computer screen to me and says, hey, listen, this is a little bit of a heavy hitter on the return. This is saving them way more than kind of industry average should be saving them. I immediately ask the client, hey, why was this expense so high? And if the client says, well, it just is what it is, like that's an area of my business that just really ended up costing me a lot of money this year. Okay, just making sure that is an ordinary, necessary, and legitimate write-off, and that it's accurate. And it wasn't. I refer to it in our industry, we refer to it as fat finger mistakes, right? Where you're plugging in numbers and all of a sudden you hit 2 numbers at the same time and it makes it, quadruple the expense deduction, right? We just want to verify that those are accurate expense deductions. Everything else still has a pretty darn low audit risk. And even though the government has allocated more funds to hire more agents under the IRS, a lot of those new agents won't be fully trained until about 2026 or even 2027. And by that time, we'll have a different tax code. We might even have a different president. Who knows, right? We've got an election coming up, lots of change on the horizon. We'll have to wait and see what the future code has in store. But those, I believe, will be the highest audit triggers that in the industry.
Thank you, Tony. Well said. I appreciate it.
Sure.
Ladies and gentlemen, that brings us to the conclusion of our seminar this evening. Thank you so much for taking the time out of your evenings to come speak with me and Tony. Tony, thank you so much for being here. That was a lot of really good information. And like I said, I learned a lot of good stuff there, and I know our clients did as well. So thank you for being available. If anyone on the call is interested to learn if investing in real estate is gonna, have tax advantages for you, please reach out to Tony. He'd be more than happy to have those conversations with you. And if it looks like that is a good play for you, please feel free to reach out to me and we can go over investment options with you. Everyone, thank you again. We're going to send out a copy of this seminar after it is concluded, and I'll be reaching out to everybody individually to answer any questions you may have. And I look forward to speaking with you all personally. Tony, thank you again so much. Have a wonderful night, everyone.
Take care.